trading friends, and welcome back to Forex Focus, brought to you by tastyfx, explaining the carry trade and how carry trades can unwind here today with a prime example in the dollar yen. We're going to go from A to Z on how a carry trade works, why you might take a look at a carry trade, and when it stops working, what can happen to the market. Let's get into it and start with a definition of what a carry trade is. And here you have our example today looking at the US versus Japan. But before we get into that example, a carry trade simply seeks to create daily positive value by investing large amounts of capital in one country's relatively higher yielding currency while financing that long position with a short position in a lower yielding currency. And so in the Forex world, this is super popular, partially because a lot of Forex pairs like the dollar yen or the euro dollar are highly leveraged. You can trade them with 2, 3, 5, 10% margin requirements and thus get a lot of exposure for not that much money, only 2% or 5% with the dollar yen currently required in margin to have a trade. So effectively, you would put up $2 for $100 worth of exposure. I believe that the euro dollar market right now has a 2% margin, whereas a 5% margin, you'd put up $5 for $100 worth of exposure, and obviously you can scale that up. And so when we're looking at carry trades, we're usually looking at large amounts of exposure and thus Forex markets that can be highly leveraged because you're taking advantage of the difference between interest rates, but you're doing that on a daily basis. So it's not large amounts of money, but it is a positive expected value on a daily basis if the price doesn't change. We'll get into the risks a little bit later because that is a key piece. But in the example here, you have a 5% plus interest rate from the US and around a 0% interest rate from Japan. And so when you go in and you long one lot of dollar yen, you're getting long $100,000 and you're using a short 14 million yen position to finance that. And that's because the price for dollar yen is 147.50 in this example. And so $100,000 would mean almost 15 million yen there. And so you effectively now have on a long dollar position that is getting in more than 5% interest on an annual basis, but bringing that down for a daily basis, still a nice chunk of change. And I'm financing that with a short Japanese yen position that is being financed at around 0%. So that interest rate differential is actually in this example going to give me about 2.5 pips or 17 US dollars given all of these numbers here. And as a quick aside, these values can obviously change not only with interest rates, but depending on different fees associated with your broker. We're looking at this example using some recent tastyfx values, but not current market conditions, just something that you could expect to be an approximation around these values. And so again, you know, in a position like this, maybe you're putting up for a one lot position and getting $100,000 worth of exposure. Maybe you're putting up, you know, $5,000 to create this position, and you're getting about $17 on a daily basis. That might not seem like a lot, but that really adds up over time. And this is what carry traders are seeking to take advantage of, essentially saying, for no change in the market, I'm able to lever up my capital using Forex market margins, in this case of 5%. You know, a 20-to-1 amount of leverage here, and take advantage of this interest rate differential and get in on a daily basis a couple of pips which in the grand scheme of things, if you're looking at, efficient market theory or probabilistic outcomes, and a market like forex, maybe in the long term, the expectation is that forex prices don't really tend to appreciate or depreciate in the long run. Maybe they have a long-term expected value of zero change. Well, every day you would, in this example, be bringing in almost $20 on your $5,000 investment, and that can create a lot of value over time. But I do want to take a look at the risks in this trade. And we're going to talk price in just a second, but I want to look at interest rates first. And this is obviously a slower moving type of risk, because the central bank has to come out and move these interest rates around. But also the market, if they're projecting that the Fed will cut or raise interest rates, the market might move before they actually do so. And in volatile times like we've seen, these overnight funding rates that are a function of US and Japanese interest rates in this example can absolutely swing around. And we've actually seen some shifting dynamics over the course of the last several years, right? The positive carry that has been created for the dollar yen started way back in 2022 when the Fed started to hike interest rates off of 0%. And quickly, by the middle part of 2023, they got interest rates up to above 5%. And in the same time, Japan didn't hike interest rates once. Actually, Japanese interest rates were negative 10 basis points the whole time. So for the period of a couple of years here, you could have gotten, 2, 3, 4, 5% interest rates on a US dollar investment, and finance that with negative interest rates in Japan. Of course, now we are seeing these dynamics shift a little bit, and they will shift. I believe that in the grand scheme of things, throughout the next 10, 20, 30 years, we will likely see these dynamics shift in the opposite direction at some point, as people who have been around forex markets long enough know that these things can really mean revert and go back and forth. But this is a big piece here. Fluctuation in interest rates will absolutely either add to the daily profits of a positive carry trade, or take away from those profits if the interest rates do converge like they do here in this example. Another piece of this, and of course this is a much bigger risk, and for those of you out there who've traded forex before, you're probably asking, well, what about the actual price or the exchange rate that I'm locking my position in at? It's nice to talk about the efficient market theory and expected values of different markets being unchanged, but we know that in the practical world that is not the case. And you see here, along with that divergence in interest rates, the positive carry that was created for long dollar, short yen traders from 2022 until just recently here, that coincided with a lot of US dollar upside, as you might expect. This stuff doesn't happen in a vacuum. As interest rates rose in the US and Japanese interest rates stayed negative, a lot of people piled into this trade, driving up demand for US dollars and driving this market to some of the highest prices that we've seen since the 1980s, when it got up there above 160 in the middle part of 2024. So this is a case where, as the interest rates diverged, and if you were long dollar, short yen, you were getting that positive carry in, the price did, at several points in the last couple of years here, actually go in your favor as well. So you would have been making that positive carry and the market moving higher. That being said, at the end of 2023 there, long dollar yen traders saw a significant drop in the dollar. And also, just recently, as these rates have started to converge, you've seen these prices move to a great extent to the downside. So can be a volatile market. and absolutely can add to or take away from those profits. And if you think of this, last year or so of trading, and you're making a couple of pips every single day, and that's calendar days, by the way. So you've got, let's say 2.5 pips times 365, and so you're up with no price change around 1,000 pips, if I'm doing my math right, maybe a shade under 1,000 pips there. But if the market moves against you by 2,000 pips, obviously that's not creating long-term success in the strategy. But here, for example, if you bought in last July when the market was around 145, 150, you saw a bunch of profits in the price, but you were getting in that positive carry. And now even with the fall recently, the market's right around 145, 150. Still creating that long-term positive value, but you have to keep in mind this price action risk, because getting in 2 or 3 pips on a daily basis can absolutely get washed away in a market like this that moves usually, anywhere between 25 and 100 pips on a given day. You're just hoping that a lot of that's canceling out. But enough of the risks and explaining what the carry trade is. I want to take a look now at what unwinding positions look like and what it means, because you can see, like I say, a bunch of people flock to a market like that and build that price higher and higher with that increased demand as interest rates are diverging there. But as they start to converge, and even in the example that we're looking at, the U.S. is maybe taking their interest rates from almost 5.5% to maybe around 4%. And Japan has just gone from negative 10 basis points to positive 25 basis points. So it doesn't seem like a lot. But as interest rates start to move in the opposite direction, and that differential goes from positive 5.5 to only positive 4 or 3.5, positions might start to unwind when those conditions like this change, and that occurs with people closing out of those positions. So maybe I had the carry trade on for a year or a couple of years, maybe going back to 2022 when the Fed started to hike interest rates and Japan wasn't moving interest rates. And now in 2024, as interest rates are starting to converge again, I'm going to close out of that. Well, a lot of people are probably having the same idea at the same time. And so you can have this massive unwind of positions similar to a sector rotation in an equity market. And if this happens in a hurried manner and there's a lot of people flooding to get out of this position and unwind this huge position that's been built over years and coincided with a dollar-yen price going from around 110, 120 to 160, which is a huge move for forex markets, and the highest price for dollar-yen since the 80s. When that starts to unwind, it can create huge price action events as well. And just taking a look at how this carry trade unwind works, you saw here in the last month, and what's happened in this case study, depending on when you're watching this, this was when the Fed started to talk about, okay, we have seen the peak in interest rates, we're going to start cutting. And the Bank of Japan unexpectedly hiked interest rates. And immediately you saw some unwinding of positions, and the market goes from 160 down to 155. And then you had a couple of data points come out in the US and in Japan, pointing to US rates maybe coming down even further than previously expected, and Japan maybe even getting more aggressive with their interest rate hikes. And that caused a ton of volatility, some of the biggest moves that we've seen in dollar yen in decades. As, like I say, people are trying to get out of these positions in mass quantities. And it's funny, forex right there with different bond markets like the U.S. Treasury is one of the highest liquidity markets in the world. But when something like this happens, when you're seeing a massive unwinding of positions, you can still see, a huge price reaction because that's a lot of people trying to sell, even in a highly liquid market like this. So definitely be wary of when these unwinds might occur. Of course, it's almost impossible to tell when, but you can usually see as data changes and as interest rates start to go from diverging like this to converging back to normal. That might be when an unwinding of positions might occur, and might be time to look at those positions for yourself. But there you have it. How to create positive carry trade strategies, how they work, and how unwinding of positions might affect it. Thanks.